Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. The year 2023 has been incredibly unusual for investing. Even in my many years of experience in the market, I can't help but feel sympathy for new investors who are just starting out, so it's become quite challenging to navigate these uncertain waters without a solid understanding of what you're doing. However, that's precisely why I'm creating this video, to provide you with a framework that will serve as a guiding light during these interesting times and help you avoid getting burned. Now, I want to make it clear that watching one video won't transform you into an investing genius overnight. However, what I can offer you are 5 valuable tips that not only I utilize, but also renowned investors like Warren Buffett to consistently outperform others and achieve long-term success. These tips are specifically designed to help you invest wisely during volatile periods. They'll equip you with the knowledge and strategies necessary to make informed decisions and avoid common pitfalls. By implementing these tips, you'll be on the right track to weathering the storm and safeguarding your investments. Know the foundations. One crucial factor that distinguishes average investors from high-quality investors in times like these is their ability to manage their emotions. Let me illustrate this with an analogy. Jordan Peterson advises us to be the dependable and composed ones at a relative's funeral. Now, let's extend this advice to the realm of investing, especially during and after a market crash. Here's the common mindset adopted by around 90% of investors. When they witness their stocks increasing in value, they experience great joy. They eagerly share their financial gains with friends at social gatherings, boasting about their profits. They frequently monitor their stocks, sometimes even on a daily basis, allowing their emotions to fluctuate along with the stock market's ups and downs. However, the small percentage of investors who consistently outperform others take a different approach. They do the opposite of what most people do. When their stocks decline in value, they actually feel a sense of satisfaction. Why? Because it signifies that the stocks have become more affordable, enabling them to purchase more shares at a lower price. They comprehend that by investing in stocks at cheaper prices over the long term, their potential returns increase significantly. This exact concept is why Warren Buffett states, "You're dealing with a lot of silly people in the marketplace. It's like a great big casino, and everyone else is boozing." The investors who come out on top are the ones who follow the principle of buying low and selling high, contrary to the majority who act in the opposite manner. To become a successful investor, it's vital to detach your emotions from short-term market fluctuations. Instead, adopt a long-term perspective and view market downturns as opportunities to acquire stocks at discounted prices. By embracing this mindset, you'll be better equipped to make sound investment decisions and achieve higher returns. Be aware of what you own. Here's a typical mindset of about 90% of investors. When they see their stocks rise, they feel ecstatic. They eagerly share their gains with friends at the bar and obsessively check their stock prices weekly, if not daily. Their emotions are closely tied to the ups and downs of the stock market. But here's the secret of the small percentage of investors who consistently succeed. When their stocks go down, they actually feel happy. Why? Because it means the stocks have become cheaper, allowing them to buy more at a lower price. They understand that the cheaper they buy stocks in the long run, the higher their returns will be. Market cycles. Now let's discuss an important aspect you need to understand: market cycles, especially in the context of 2020, where we find ourselves in the later stages of a cycle. It's crucial to know which stocks perform well during different periods. I'll share an old-school graph that will help clarify this concept. As you can see, during the early to middle stages of the market cycle, transportation, technology, and capital goods stocks tend to thrive. This is because the economy is expanding, and there's increased demand for transportation services and technological advancements. Additionally, technology stocks often have lower valuations during these times, making them attractive investment opportunities. For instance, companies like Netflix, Tesla, and Amazon experienced significant growth when the market was starting to heat up about a decade ago. However, as the market enters the later stages of the cycle, more conservative stocks tend to perform better. Consumer non-cyclicals and healthcare stocks become favorable choices. Even during a market downturn, people still need essential products like food, toothpaste, soap, and clean water, which fall under the category of consumer non-cyclicals. Investing in healthcare stocks also makes sense as people require ongoing healthcare services. Understanding these patterns is crucial for beginner investors. Remember, even if you invest in the strongest stock, it may underperform if it belongs to a weak sector. That's why I recommend following Ray Dalio, who provides historical evidence and relates it to the present market conditions. This helps us gauge where we are in the market cycle and adjust our portfolio accordingly. As a beginner, you may wish you had started investing 10 years ago when the economy and market were in the early stages. However, it's essential to focus on the current market conditions and apply the tips I've shared with you. These insights will help you navigate the unique market conditions of 2020 and beyond. I wish you the best of luck in your investing journey, and I hope you achieve your financial goals. Remember to stay informed, adapt to changing circumstances, and make wise investment decisions based on market cycles and sector performance. Daily News. Imagine if you invited someone who had never driven a car before to participate in a high-speed race with experienced drivers. Each participant would contribute a significant amount of money as an entry fee. It would be unwise for the inexperienced person to agree to join because they lack the necessary skills and knowledge to handle the intense competition. As a result, they would likely find themselves at a disadvantage and risk losing their money. Now let's apply the scenario to the stock market, where many beginner investors jump in without a basic understanding of how it works. As a result, they often end up disappointed and lose money within a short period. If you're new to investing in the stock market, especially in these uncertain times of 2020, it's crucial to learn some essential fundamentals. Let's break down a few key concepts in simple terms. First, there's the PE ratio, which measures the price you pay for a stock compared to the earnings it generates. It helps you assess whether a stock is overpriced or reasonably valued. Another important metric is return on equity, which tells you how well a company uses its assets to generate profits. Understanding these metrics will aid in evaluating stocks. It's also essential to familiarize yourself with different types of stock market orders. Let's simplify them. A limit order allows you to set a specific price at which you want to buy or sell a stock, while a market order means you'll buy or sell at the current market price. A stop limit order combines aspects of both, allowing you to set a specific price at which a stock is automatically sold if it falls under a certain threshold. Furthermore, explore various fundamental strategies that successful investors employ. Have you heard of Warren Buffett's value investing strategy? It involves buying stocks at a price lower than their true worth, aiming for long-term growth. Another strategy to consider is the dividend aristocrat approach, which focuses on investing in stocks with a consistent track record of increasing dividends over time. These strategies have proven effective in beating the market, as historical data suggests. Before diving into investing, it's crucial to grasp these fundamental strategies and tactics. Familiarize yourself with concepts like the PE ratio, learn about different types of stock market orders, and explore strategies employed by successful investors. This knowledge will provide you a solid foundation for your investment journey, increasing the likelihood of making informed decisions. Remember, investing is a learning process, and it's essential to build your knowledge gradually. Take your time to understand these basics, and don't rush into risky investments. By gaining a solid understanding of the market, you'll be better equipped to navigate the ups and downs and make sound investment choices. Good luck in your investment journey, and may it bring you success and financial growth. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.